Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fujita. Let's get you up to speed on the market action. Certainly a wild day on Wall Street. All three the major averages trading to the downside, although we are off the lows of the session. The Dow now off just around 380 points, S&P off just about 1%, as well as the Nasdaq. Certainly a risk-off day as there is worry about the stability of the banking sector. All 11 of the S&P sectors trading to the downside this afternoon as we enter the final hour of trading. Regional banks selling off, but also a number of the larger banks as well. In terms of the underperformance, their biggest losses we're seeing in energy, financials, and communication services. But let's get you up to speed on the biggest movers of the day, and that's regional banks. Fear in the sector is not going away as shares of PacWest, also Western Alliance, tumble. You're looking at losses of 25% for PacWest, Western Alliance off just about 16%. Now this drop coming the day after JPMorgan Chase did reach a deal to buy First Republic Bank's assets in an attempt to restore stability in the banking system. But investors do not seem convinced. When you take a look at the action today, Kiko, I think it's clear that investors are trying to figure out who could potentially be next. And this comes, remember, just a day after we heard from a number of bank CEOs, including the CEO of Citi, Jane Fraser, right here on our program yesterday, saying she is very confident in the U.S. banking system and that it's really the envy of the world.
Yeah, you know, Sean, I was going to say what a difference a day makes, right? Yesterday, we were talking about the calm sort of being restored in the markets. It wasn't just Jane Fraser. We heard from JPMorgan CEO Jamie Dimon, who came out and said, look, everybody needs to take a breath and that the initial phase of this banking crisis was over. The market certainly not convinced, as you point out, looking at these two regional banks, and really not a whole lot of news coming on the back of that. It really is about concerns about the deposits, whether there's going to be a further withdrawal here. Worth noting, by the way, both of these companies posted earnings results in April that indicated that their deposits had stabilized. In fact, PacWest said deposits began rebounding in late March. That didn't seem to matter today. And by the way, worth looking at the KBW Regional Banking Index, which was down in a big way overall.
Yeah, certainly down in a massive way. When you take a look, I think the sentiment is really mixed on the street because you have a handful of investors clearly worried. You can see that by today's action because of what could potentially come. We asked Dick Beauvais yesterday if there was a potential for another bank to fail. And what he said was there's absolute certainty that another bank is going to fail. And he said what the people are looking for out there on the street right now about whether or not the exposure here to fixed rate mortgages, also exposure to commercial real estate. So still some of those banks that had been viewed over the last 6 weeks at risk, in addition to First Republic, are the ones that are seeing the biggest losses today, even though, like you said, deposits certainly trending in the right direction at the end of the quarter.
Yeah, and by the way, we have a Fed meeting and a decision coming tomorrow. And of course, the concern is that further rate hikes are going to eat into profits of regional banks. But want to expand the conversation here. Let's bring in Todd Jablonski, Principal Asset Management CIO of Asset Allocation. Todd, let's just get your take here. It seems like the market isn't convinced that things have calmed down. Where are you on financials right now?
I think financials as an equity sector fall into that risk-on category that we've been sort of shifting away from tactically as we begin to see the U.S. economy slow down. Really, I think equity investors have been over-optimistic for quite a period of time. You've had a base case, I think, baked into investor expectations that you might see some Fed easing maybe towards the back half of this year and maybe into 2024. And I think that hope took equity investors into misguided places. I think a more rational expectation on what we see in terms of earnings growth in the U.S., maybe this year around 1%, and a slowing economy as the Fed's tightened 475 basis points in 1 year, in this cycle. That's meant for a lot of pressure on financials and on risk-seeking equity exposures.
Todd, do you think this at all changes how the Fed is looking at and maybe affect the Fed's decision, not so much tomorrow, but maybe what they could potentially come down with in June?
Well, we expect an additional 25 bip hike coming tomorrow. And that's in keeping, I think, with where the Fed mandate needs to be focused right now, around price stability over financial stability. That tension that the U.S. central bank is facing is really being shared by other central bankers around the world. And we think that those forces are really designed to arrest and should be focused on inflationary forces. Persistent, above expectation inflations is really the more damaging element to the economy. So I think you'll see the Fed continue to lean on arresting that excess demand that's pulling through those price increases.
Todd, well, we've got the regional banks, the sell-off there kind of, leading the declines in the market today. We did get some data that, seemed to suggest things are moving in the right direction. We could say it's bad news is good news with the JOLTS report. We saw job openings hitting a 2-year low. I realize, the Fed doesn't just move off of one particular data set, but when you look at what we heard today or what we saw, what does that tell you about just how the Fed's policy is taking hold, at least within the labor market?
At least within the labor market, you are indeed seeing signs of a bit of slowing that I think sort of validates the approach that the Fed's taken in order to, I think, really slow down the pace of economic activity. But I don't know the labor force is really the key variable to be watching. One, labor is a lagging indicator, so it's giving you information on a delay. Two, it's not just about the unemployment, it's about the labor force participation. 7 out of 10 Americans were part of the labor force before COVID pandemic. After the pandemic, it's about 6 out of 10. So even though you're seeing some hiring in labor begin to slow, I think for the recovery side, you're going to have to see a dramatic re-increase in labor force participation. And I think that's the mechanism across the labor market that really leads us forward.
So Todd, given all that, is it time for investors to stay defensive? How should they be allocated?
Well, tactically, as an asset allocator, I think it's wise to look at one's risk appetite and scale back in terms of where investors are reaching for return. Perhaps an underweight of equities might be advisable as we think about how to tactically shift a multi-asset portfolio, taking that equity exposure down, pushing down your expected levels of risk in favor of more defensive opportunities. In particular, I'd point to core U.S. dollar fixed income as having appeal today. Whether that's treasuries, mortgages, IGC, core fixed income had a very difficult year in the last two calendar episodes. But in 2023, we're up 3.5% through the early going. And I think that you can go back to expecting stability and income from your U.S. core fixed income holdings. That's something that's been missing and could hold appeal tactically to investors today.
Todd, even within equities, you've talked about increasing exposure to outside of the U.S. emerging markets. We heard the IMF overnight coming out with their revisions on growth within Asia, sort of saying that they believe that momentum is starting to pick up, at least with the China reopening. Is that part of your base case here, that things could really start to pick up there, and therefore investors should be allocated a little more outside of the U.S.?
Indeed, I think we're seeing pressure on not only the delivery of U.S. earnings, but also on the strength of the U.S. dollar, which had really buoyed U.S. returns for U.S. investors. But here in 2023, again, as I mentioned, you're looking at 1% maybe earnings growth from U.S. stocks and 13% expected this year from Chinese equities. 15% earnings growth expected in 2024 from Chinese equities. So as you begin to look across the globe and consider the investment set, in China, you have not only positive economic surprise, but negative inflation surprise, coupled with strong fundamental delivery of earnings. That adds up to a more attractive equity package. And so we underweight the U.S. inside of our asset allocation strategies with the preference towards EM. And the complex not only includes the growth trajectory of China, but also good value opportunities across Brazil, Chile, other Latin American economies, where from a valuation standpoint, you see opportunities that haven't existed since 2003. So as a basket, EM equities holds appeal, we think, in a balanced approach.
All right, Todd Jablonski, great to have you on here. Principal Asset Management, Chief Investment Officer of Asset Allocation. Thanks so much. Let's get to a big mover today, and that is Chegg. The stock hitting a new 52-week low, trading at the lowest level that we've seen since April 2017. You're looking at losses of about 50%. Chegg's CEO, Dan Rosenzweig, saying on the company's earnings call last night that they are losing market share to ChatGPT. Joining us now, Yahoo finance reporter Josh Schaefer. Josh, you've been reporting on this story today. Certainly, the street's a little bit worried about the comments that we heard from Rosenzweig about ChatGPT. How big of a threat do you think this really is to their business?
It seems like a lot based on the market reaction, right? I mean, you're seeing that stock off, as you said, Shauna, about 50% today. And the stock had been down over the past several months already on fears of ChatGPT. And I think one thing to point out when we talk about Rosenzweig's comment there was that was part of the prepared remarks. Chegg came into this earnings call ready to basically warn that ChatGPT is starting to be a legitimate concern for them. And this comes a week after they started or announced a partnership with OpenAI to use ChatGPT 4 to build out their own AI product. So I think that's part of the investor concern here too, is Chegg is clearly saying AI is part of the future of online learning, but they need OpenAI and ChatGPT to create that product. And so when you think about the larger investor story here, the question becomes, how much is Chegg going to have to pay to be able to use OpenAI and include that in their platform? And then what are they going to sell it for? And when that was asked on the call, Chegg didn't have a straight answer on what the plan is as far as monetizing AI goes, or when AI is even going to come to market for Chegg. And so clearly some big concerns here, Kiko, as far as where things are headed next for Chegg.
Yeah, Josh, that's interesting because I read those comments and I sort of thought, well, is this part of Dan Rosensweig setting the expectation because their AI development is still far behind? I mean, how much catch up do they have to do in, are they kind of dead in the water at this point?
They definitely have to do a lot of catch up. And I think really what the problem is going to become is you're dealing with students, and specifically when you talk about Chegg, a lot of their students end up being college students, right? And it spreads on college campuses. And one point that Brent Thill at Jefferies made today in his note that I thought was interesting was Chegg benefited from word of mouth and spreading on college campuses basically by becoming popular. That's what ChatGPT is right now when you think about what's happening with the Gen Z era, the fastest growing app ever. That's what ChatGPT and OpenAI have done. And so to see what was once a growth catalyst for Chegg, when you think about word of mouth and students sort of saying, hey, I have this great study tool, you should check it out. Well, now ChatGPT is being used in that way. And I should mention, ChatGPT is free. Most options on Chegg are not free. When you're a student, you're probably going to lean toward that free option if you do find it helpful.
Yeah, certainly a very important distinction there. All right, Josh, thanks so much for that. Well, we are just getting started here on Yahoo Finance Live. Coming up, we check in at the Milken Institute Global Conference and hear from Guggenheim Investments co-president Dina DiLorenzo, as well as Mark Metrick, the CEO of Saks. You certainly want to miss those conversations. Plus, earnings season rolls on. We break down the numbers from Ford and Starbucks when they report after the bell. And be sure to stick around for After the Call. Our very own Shauna and Brad Smith will tell you what you need to know from the Starbucks earnings call. It all starts at 6 p.m. Eastern right here on Yahoo Finance. We'll be right back.
The increasingly popular ChatGPT has created a frenzy of conversation around the growth of AI, but not everyone is happy about it. In the past few months, we've heard a number of warnings around the development of AI tools. Well, in late March, an open letter calling for a pause on AI experiments was backed by Elon Musk. And now the, quote, godfather of AI is joining that call, warning that AI could be used by bad actors for bad things. Yahoo Finance's Diane King-Hall has the details. Diane, not necessarily something that you want to hear from the godfather of AI.
Yeah, that's right. The godfather of AI, Geoffrey Hinton. He's, again, known as the godfather of AI. He's sounding the alarm on artificial intelligence and the potential dangers associated with it. This comes on the heels of leaving his job at Google. Now, today in an interview with MIT's Technology Review, he said the concern is not just the technology getting smarter, but it figuring out ways to manipulate or kill humans. He said, quote, I want to talk about AI safety issues without having to worry about how it interacts with Google's business. Now, the 75-year-old British expat's career has hinged on the development and use of AI since the 1970s. His work is so recognized that he won the Turing Award in 2018, often dubbed the Nobel Prize of Computing. Yesterday, he announced his departure from the tech giant in an interview with the New York Times. The biggest risk he talked about was seeing the difficulty in preventing bad actors from doing bad things with AI. He's worried about future versions of the tech posing a threat to humanity because it can learn unexpected behavior from the data it receives and analyzes. In other words, once upon a time, he believed that the human brain was far superior to AI. Now he is worried about the potential for the tech to get smarter than people.
That is always going to make people nervous if you're thinking the AI is going to be smarter than us.
Right.
You know, we've had a number of executives that have come out and said, look, it's time to hit the pause button on AI because things are moving too quickly. Why is he sounding off now?
That is a good question, because he talked about why he didn't sign that letter that Elon Musk signed and others in the industry, and there's another circulating within that ecosystem, and why he didn't sign that. He said he wanted to be clear of his responsibility to Google, if you will, and to be free and clear to speak freely about AI. Now, he did clarify in a tweet, he said that he left his job so he could speak publicly. He says that Google has acted responsibly when it comes to AI, so he's distancing his old company from the issues that he's bringing up with regard to the potential threats and red flags that could occur from the use of AI and this rapid acceleration that we've seen with regard to its use, from not just, like you all talked about earlier, issues with regard to education and cheating, but just far worse things such as election misinformation and the potential to pivot elections and or war issues.
Certainly a lot of risks out there, why so many people are now out there warning about the dangers of AI. Diane, thanks so much.
All right, you got it.
We want to continue with the artificial intelligence conversation. The development of AI may have big implications for workers as well, and it's already starting to impact jobs. IBM CEO Arvind Krishna saying that the company plans to pause some hiring in the coming years for jobs that could be replaced by artificial intelligence. Now, Krishna making the comments in an interview to Bloomberg on Monday. This hiring pause amounts to about 30% of IBM's non-customer facing roles over a 5-year period. And Akiko, when you take a look at the fact that CEOs, a number of CEOs are already coming out talking about the risks, talking about the fact that AI is clearly going to impact their workforce. Goldman was out with a note pretty recently saying that they expect AI to impact about 2/3 of jobs, but on the flip side, could also potentially drive about 7% growth in global GDP over the next 10 years. So yes, some jobs will likely be eliminated as a result of AI, but it could potentially here create many new ones that we haven't exactly thought about yet.
Yeah, I mean, you imagine for companies, it really is about improving efficiency. And we've talked a lot about technology sort of replacing workers, at least, you know, those that are more labor intensive. Now we're talking about jobs that are some would describe as white collar, administrative jobs, secretarial jobs. You know, that's got to make a lot of people nervous when you hear a company like IBM saying that those jobs could be replaced. Certainly, of course, it feels inevitable given the conversation about AI over the years. But there's another thing that we've been talking about. And Shauna, it feels like there's not a day where we're not talking about another industry being disrupted. And AI could have a big impact In Hollywood now, the Writers Guild of America, including the regulation of AI in its contract demands, the fear here is that movies and TV could one day be written by AI software. Of course, the Writers Guild now agreeing to go on strike because they couldn't reach an agreement with the studios here in Hollywood. But here's some interesting nuggets, I think, to pull out from here, Shauna. When you think about it, the use of AI being the big issue here, there's two stipulations the WGA is looking for. Literary material. So we're talking about screenplays, treatments, cannot be generated by AI. It needs to be a person. And ChatGPT can't be credited with writing a screenplay. But the other thing that I think is kind of interesting here, the WGA also saying that source material, so this is a novel or an essay that inspires a movie, that also cannot be written by AI. And that's kind of the area that a lot of people have been looking in since ChatGPT came out, saying that how are we going to know if a book is written by AI? WGA saying, well, that needs to be made clear, and it cannot as part of this agreement they're looking for.
Yeah, and I think it makes a lot of sense. We talk about the fact that this is really impacting almost every single industry. You talk about Hollywood, the impact there. It makes a lot of sense why the writers there are calling for this to be in their contract. We've already seen it affect our industry, journalism. A number of companies more and more are starting to use AI to generate some of those articles. And when you talk about the fact that it's hard to distinguish who uses AI versus who does not when it comes to ChatGPT, teachers are having a very tough time trying to figure out whether or not students are plagiarizing, I guess you could call it that here, when they use ChatGPT instead of writing their own essays. So it makes a heck of a lot of sense as to why these writers are calling for this to be included in their contract. We'll see whether or not they're able to get that in there. All right, well, coming up, renewed uncertainty about regional banks. Well, that's sparking more selling on Wall Street. Brian Sozzi's conversation with Guggenheim co-president Dina DiLorenzo at the Milken Conference is next.
People are actually going to need to figure out how to be good investors going forward. And in a market that has adjustments, corrections, deviations, stresses, that's an Apollo market. You don't make long-term investments if you're measured quarterly. The whole notion or soundbite of private equity as ravaging businesses was always that, just a soundbite. We are $400 billion of private credit today, which sounds large, but I assure you, Jamie Dimon, Jane Fraser, Brian Moynihan, Charlie Sharp, they don't wake up every day wondering what the mighty Apollo is doing. And I like that.
we're starting to play out in Treasuries, some of the pricing. There is rising concern here. We're starting to see the investors paying more attention to it. And I hope that will act as an impetus to get this resolved in a bipartisan way. We're a bank on a mission. We're very clear about who we are. We are the preeminent banking partner for institutions with cross-border needs. Full stop. That's it. There's no arrogance about people at Citi. We want to understand, help our clients put the solutions they need in, take real pride in it.
I think this phase of any crisis is over. I don't think there's a whole bunch of others. If you look at what's happening in inflation, it's sort of saying that we're looking at some sort of a recession. How hard, how long to be determined. One of the primary reasons why TD bought Cowen is our amazing research. Culturally, great alignment. A lot of work to be done understanding how to operate our business model inside a globally systemic important bank. On the combined platform, where can we go? What are the things we can do? We have a full suite of products and opportunities in front of us. Let's pick and choose the ones where we can go out and take meaningful share.
Regional bank stocks are sinking today amid fears the worst of the banking crisis may not be over. But many finance executives are sharing optimism about the health of banks. My colleague Brian Sazi sat down with Dina DiLorenzo, Guggenheim Investments co-president at the Milken Conference here in LA. DiLorenzo says her peers are excited to find solutions to make sure these bank failures don't happen again.
People are definitely optimistic. They are excited to find solutions, and they're communicating openly and I would say on a regular basis. They're just really thinking about what should we be doing to prevent these mistakes.
How should one prepare their portfolios for what we're seeing in markets right now?
You know, I think diversification is really key, and also really understanding the client's needs. I mean, we listened to a lot of different clients today, and depending on the type of client, duration could be very important to them, liquidity could be very important to them, or not. So depending on what their needs are, and that's what we do at Guggenheim Investments. I mean, we really focus on listening to what our clients need and creating the right solutions for their profile.
Are they navigating towards more, safe haven type investments?
I think it's a combination. I think that, you know, as a fixed income manager, we're really well positioned for a recession that everyone believes is coming.
That we've been hearing about since last year.
Right.
Okay, let's be clear. Okay,
and you know, it was interesting, they went around the room today and they asked, you know, when do you think the recession's coming? When do you think the recession's coming? And we got the first bookend was the third quarter of this year,
and
then someone said January of 2024. So, and then if you read, you know, what the Fed's saying and some of the other economists out there, I mean, they're saying it could be a soft landing, a form of a recession. So again, I think it really depends. So, you know, what clients have dry powder. We also see because of the volatility in the markets and the uncertainty, we're now seeing a lot of interest from clients that normally would have allocated some of their dry powder to equities, because our firm specializes in providing, you know, equity-like returns with very low volatility in some of the, you know, where our core competencies are, which is private debt, corporate credit, structured credit. We're able to really find value for investors that are usually unrepresented in traditional indices. So I think, again, it depends on the needs of the clients, but I do believe there's more of a demand for fixed income right now, so we feel pretty good about that.
Have you been unsettled at all by what the Fed has done? Series of rate hikes, likely to come out this week, another rate hike. What has that done to fixed income markets?
Well, you know, I think everything seems a little uncertain, right? I think that before the banking mishap and with SVB and now with First Republic, I think people were expecting a more aggressive stance, but I think the Fed probably got a little bit of a break with the banking and incident and credits tightening. So we'll see. I mean, I think, again, our clients, we've been very active over the last several months, particularly the last 6 weeks, managing our clients, talking to our clients, talking to prospective investors, people who really just want to learn about our views, and keeping a very close watch on where the opportunities may present themselves.
What is one of your top investment themes right now inside the firm?
Well, we have a variety. I would say it's credit loss aversion. That's what we're good at, and we don't change our structure. We stick to our process. It's a tried and true process, and when we do that, that is always been a great result, right? And that's our strategy.
There's always competition in the asset management industry.
Yeah.
What's next for this space? I can't imagine competition is going to slow down at any moment.
Well, we like competition, right? I mean, you want competition. We actually work really well with our peers. We're a nice complement to our peers. We like to figure out how they approach certain things. We do things differently. We're a team-based approach. We're not a star system. What's next is you'll probably see a lot more consolidation. And I think it's the firms that really stick to their process, stick to their strategy, that'll continue to be successful and serve their clients with excellence. And that's what we've been doing for the last 20 years I've been at Guggenheim.
All right, that was our very own Brian Sazzi, along with Guggenheim Investments co-president Dina DiLorenzo from the Milken Conference out in LA. All right, well, coming up, we check in on some of the trending tickers and stories as we continue to count down to the closing bell. 3 names that are actually bucking the downward trend today here in the broader markets. We'll tell you why when we come back.
The state of commercial real estate remains fragile as industry stakeholders and thought leaders convene at the Commercial Observer Spring Financing CRE Forum to assess the lending climate, the effect of ongoing vacancies, and the need for the public sector to pitch in. Falling property values and billions of dollars in maturing debt was also top of mind for the 300 commercial real estate experts gathered in Manhattan to discuss the challenges facing the industry.
We've seen the banks retrench. We've seen the CMBS, commercial mortgage-backed securities market, really not be as efficient as it normally is. The CLO market, collateralized loan obligation, also not efficient. So what it's done is really whistled down the available financing pool to a very select group of lenders.
The regional banks were big lenders, especially to the multifamily space. So someone's got to step into that void. I think there's 2 things. One is who's going to step in to make the new loans, and the second thing is what's going to happen to all those other loans that are now going to be sold.
And lenders are cherry-picking deals, which means the type of real estate that will do the best are A-class, trophy buildings with gleaming finishes and sustainable features. As a result, owners of less desirable buildings are facing an uphill battle. And cities are still feeling the effects of the pandemic, namely empty desks and decreased demand for office and retail space. Industry insiders say it's time to rethink or reimagine the commercial real estate market.
There's a kind of this tale of the have and have-nots within the commercial real estate industry, especially for office. But not every building can be repurposed as residential. And so what are you going to do with that building? Can you use it for another use case that hasn't been thought about before? Are people going to use co-working space in a new way? I think it's going to necessitate serious rethinking of how we view space.
There's no easy solution to the challenges the industry is facing, such as mounting debt, and it remains to be seen how bad a downturn in commercial real estate will be.
We have a huge housing shortage at all levels. Low income, affordable, middle income, workforce. So we have to figure out a way to take these obsolete buildings, not easy, complicated, and to convert them, because it does work.
Is that the future for the hundreds of empty office buildings making up the New York cityscape? Only time will tell.
Time for a triple play. 3 stocks that we're watching in the final 30 minutes of trading. We've got Marriott, Molson Coors, and Coinbase. Kicking it off with Marriott. People are eager to travel, and this hotel chain is obviously getting a boost from that. Taking a look at shares, up just about 4.5% after Marriott beat on both the top and bottom lines. Also raised its guidance as demand for leisure travel is making up for the sluggish recovery that we're seeing in business travel. Revenue per available room, that jumped 34% from a year ago. Now, despite sticky inflation, also the risk of recession, CEO Tony Capuano saying that there are not any really signs so far of slowdown and that demand does remain strong. And Akiko, Marriott is just the latest travel name here to really reiterate the fact that people are eager to travel. They're willing to pay those higher prices, not only on hotels. We heard it from a number of the airlines too. We know airfares are up pretty dramatically on a year-over-year basis. Despite that, though, that's where people are allocating their spending in this inflationary environment.
Yeah, Shauna, I can attest to that. As somebody who just traveled internationally a few weeks ago, I mean, there is real sticker shock when you look at the price of the ticket, the price of hotels, the price of even Airbnbs, but it points to just this eagerness, the pent-up demand we've been talking about, although probably not as much pent up anymore. It is just this willingness on the part of the traveler and consumer to really just shell out money for that trip they've been saving up for, hoping to go on for several years now.
Yeah, and lots of attention on China's COVID-19 recovery here. So more specifically in Greater China, revenue per an available room is up 78.3%. Meanwhile, in Asia Pacific, excluding China, up 112.8%. So not only this company keeping a close eye on the recovery in China, but certainly other consumer-facing companies looking to do the same. As you noted before, that pent-up demand continues. Now, moving to another consumer-facing brand, my pick today is Molson Coors. Shares of the beer company jumped 10% following its first quarterly earnings results that beat estimates. Now, this quarter adjusted profit grew by 82.3%. That was boosted by higher prices and a favorable sales mix. Here in the U.S., its core brands, Coors Light and Miller Lite, saw revenue grow double digits. Now, the company reiterated its 2023 guidance of low single-digit sales growth compared to that of 2022. But the CEO did say, quote, inherent uncertainties still exist with the beer industry softness and the impacts of continued global inflationary cost pressures. And so many analysts could not help but to ask on the call about any shared gains from that current pressure that Bud Light is facing following their partnership with Dylan Mulvaney. Now, the CEO said in the call, we haven't factored in any of the trends that we've seen in April into our guidance. And we really, and I'm sure nobody has any idea about how long these sort of trends are going to continue. So we emphasize that they are not factored into our guidance at this point. He went on later on, as many analysts asked about this shared gains, potential opportunity of investments here, to say that they're focused on their brands as of now.
Yeah, Brooke, I mean, I know you've been looking at the impact of inflation, especially, you know, among food as well as beverages here. I mean, you'd imagine that's kind of where it's been really sticky. That's sort of the additional extra spending, right, when you think about where they compete in terms of the marketplace. But interesting to see just where the market is moving on that front, Shauna.
Yeah, where the market is moving and how much Molson Coors is really going to be able to capitalize on the fact that Bud Light is losing market share. The latest data that we've gotten out from a number of the industry groups really showing that more people are willing to spend on Coors Light and Miller Lite within this environment. We'll see whether or not that sticks. But Brooke, actually what caught me by surprise is he really did not want to directly answer those Bud Light questions. He skirted it a number of times, basically saying that the company is looking past it. I don't think that was a huge surprise. So we'll see whether or not these gains in market share, if they're going to last or not.
Yeah, let's talk about my pick here. Coinbase, a bit of a turnaround in the session today. We are seeing it now up 3% there, roughly. That stock initially fell, though, on a downgrade from Citigroup, saying that regulatory threats could weigh on its core business. The company, of course, facing potential legal action from the SEC over alleged violations. The SEC says Coinbase offered and sold unregistered securities. This afternoon, though, Coinbase announced it's going to be launching an international exchange in Bermuda that would list Bitcoin and Ether perpetual futures. Now, worth noting here, perpetual futures are sort of different from standard futures contracts because they are closer, they trade closer to where the spot market is. But this is an interesting one for me, guys, because, you know, when you think back to the collapse of FTX and the criticism that really arose here in the U.S., it was about the tight regulation happening here that was pushing, or at least those in the crypto industry argued was pushing exchanges overseas where there was a lack of regulation. That's where we've seen some of the challenges popping up. And Coinbase kind of alluded to this in a blog post they put out today, and I'll read you part of that. It said, rest assured, Coinbase is still committed to the U.S., but countries around the world are increasingly moving forward with responsible crypto-forward regulatory frameworks to strategically position themselves as crypto hubs. They went on to say, we would like to see the U.S. take a similar approach instead of regulation by enforcement. So that's sort of taking a shot at the SEC, but also saying, look, you want to regulate us here in the U.S.? We'll do what other exchanges have done, and we'll go international.
Yeah, and it's been quite the run since Coinbase went public, rather. I mean, since the stock high, 52-week high, it's off more than 60%. Compared to a year ago, shares are down more than 54%. But Coinbase does remain on Cathie Wood ARK Invest stocks to buy and stocks to watch. And so lots of investors following this closely. And I think this is just yet another reason why analysts are keeping a close eye on shares.
Yeah, certainly moving offshore, we'll see whether or not they're able to compete with some of the other competitors who already have a presence in some of those spaces. We know that Coinbase has had some challenges here in terms of their international opportunities in the past, specifically what happened in Japan. But Akiko, I'm so happy you brought up that blog post because it was so interesting, the wording that they used in that. And they called that the regulation by enforcement approach a disappointing trend. So they were still saying that they want to be here in the U.S. They still see opportunity. They just don't love the way things are going right now. So we'll see how that goes. All right, guys. Well, coming up, Uber shares. It's one of the trending tickers as well today. Shares moving to the upside on the heels of its first quarter earnings report. We're going to speak with an analyst about the road ahead for the ride-sharing giant when we come back.
Well, Uber has been one of the big winners on Wall Street today. Take a look at that. Shares soaring well above 10% after the ride-hailing giant reported its Q1 earnings. Uber not only beat estimates on the top line, revenue for the quarter skyrocketed by 29% year over year. Joining us now is Brad Erickson, RBC Capital Markets equity analyst. There's sort of the obvious beats that you point out that we saw today, but I want to start with what you saw in the report that may have surprised you. What stood out?
Yeah, I think, the big debate on Uber as we think about certainly this year and into next year is I think everybody understands now that they're going to hit profitability targets, probably exceed them, frankly. But I think people are concerned that expectations may be too high over the next few years on bookings growth in particular. And I think we know that prices have increased. We know that Uber has benefited a lot from that in the last couple of years since the pandemic. Frequency is the thing that has really held them back. Frequency, meaning how often people, the individual consumer is riding, is actually significantly lower still than pre-pandemic levels. Today's report highlighted a 10% increase in mobility frequency in particular. That's meaningfully better than I think a lot of those folks who don't believe in the story at this point. And so I think when you're adding customers and you're adding frequency, you give a lot more credence to a 15, 20, 25% sort of long-term bookings growth outlook.
Brad, what about whether or not this momentum can stay intact? Because I think Uber has really weathered the slowdown in the economy, higher inflation, much better than many analysts had initially anticipated.
Yeah, no, I mean, I think, they still have some very unique drivers that are helping the business sort of rebound in general. I think one of the things they talked about today was, companies are getting a little bit more hardline-ish on getting employees back to work. They benefit from commuters in particular, even more so than Lyft, in fact. Travel, we know, is super strong, both in the US, also Europe. A lot of the travel companies we covered talked about European strength. And so I think as you get a lot of those airport rides, that is a disproportionate contributor here as well. So I think you do have areas of strength, even as you pointed out, the inflationary environment is tough. These companies also have pricing power, and that's really, I think, reflected in the results that we've seen here lately.
Yeah, Brad, you talk about the mobility part of it. Certainly, there's still more upside when you think about where we are in the return to work. Uber stands to benefit from that. What about the Eats business? How are you looking at that right now? Because for so long, especially at the height of the pandemic, that was seen as the big driver when people just weren't taking the rides.
Yeah, I think that business continues to grow better than anyone thought. For the last year, as inflation ticked up so significantly, everyone was convinced that the consumer was eventually going to fall off a cliff, and that's become this boogeyman type of thing, and it just hasn't materialized. And I think between DoorDash and Uber, we continue to see evidence that people are continuing to order online for delivery. I would say at this point, there is some evidence to support the view that people are ordering fewer items potentially, so item elasticity, but they are spending more as a function of those higher prices, and they're continuing to order. And so long as we can tell that trend continues.
Brad, in this call, management didn't shy away from commenting about their big competitor out there, Lyft. They did say that they're a very, very strong brand. They're not going anywhere. They've gotten more competitive on pricing. How big of a threat realistically is Lyft right now to Uber, just in terms of regaining some of that market share that they've lost?
Yeah, I wouldn't say they're a threat too much. I do see this market as potentially having the potential to be what I'd call a stable duopoly longer term. Lyft does need to right the ship. They've had to reduce price, and we do think that is driving some reversion in terms of market share. I think that's a temporary thing. I think you will see this market get back to sort of an equilibrium level in terms of market share. If anything, Uber could turn the screws. They could affect change that could push Lyft's market share down further. They don't want to do that. They're being super rational operators. They are tracking towards these profitability targets, and I think structurally they know they're still in a good position. We believe they have a structural advantage, in fact, because of the scale that they have both on the rider and the driver side.
Finally, Brad, you've got a $46 price target on the stock. We're at 36, so just more upside here. What do you think is going to be the biggest driver that gets you there?
Yeah. So what needs to happen? I think, like I said earlier in the program, investors generally already believe in the $5 billion EBITDA target that the company's pointed everyone to for next year, so in 2024. So there's not a lot of intrigue around that in the stock. I think where the debate is and the sort of wall of worry to climb is on that top line bookings growth. And so I think as you move through this year, as the market gets better evidence potentially that this can be a 15 or 20% grower in the out year, that $5 billion I mentioned is going to be a $7 billion potentially in 25 and grow thereafter. That's where the stock will suddenly appear very underappreciated and can work towards our target.
All right, Brad Erickson. Great stuff. Thanks so much for looking at Uber, up just about 11% today, up 47% year to date. Coming up, we count down to the closing bell and check in on markets as we near the end of what has been a tough Tuesday. The Dow now off 394 points. We'll be right back. All right, we are nearing the end of what has certainly been a down day on the street. All three of the major averages trading to the downside, all off just about 1%. Some fears, some questions about the stability of the banking sector. Some of the turmoil that we've seen in regional banks is really dictating today's action. Ines Ferre is here with a closer look at the losses we're seeing. And Ines, it's pretty much across the board.
Yeah, that's right. Turmoil across the board. So let's start out with what's been happening with Treasury yields, because we have been seeing movement on those yields to the downside, especially on the shorter end of the curve. So most of the action that we saw a lot was on the 2-year, on the 3-year, down 17 basis points. Also the 5-year down as well, and the 10-year. Now, when you see that shorter end movement, that's basically when traders are predicting perhaps a deterioration of the economy, the anticipation perhaps that the Fed may have to pivot sooner than it thinks. Moving on to what's been happening with the bank stocks, the banking turmoil that we have seen recently. I'm going to pull up a chart of the regional banks here. So you saw that First Republic was acquired yesterday by JPMorgan Chase. We spoke to a lot of experts saying, okay, this crisis has been contained. JPMorgan CEO Jamie Dimon saying that the crisis is over. But obviously, when you see this movement with the regional banks, the market may not be thinking that this crisis is over. So you're seeing the regional banks severely under pressure, and you're seeing a little bit of bifurcation, a little bit of divergence between the big banks and the regional banks. Big banks today under pressure as well, except not as much as the regionals. So where are investors going to today? Well, let me pull up the Dow right here. You can see a little bit of spots there in green, and these are some of the defensive names. You've got J&J. During a recession, you need healthcare. You've got Merck that's also up more than 1%. And if you're going to go to a restaurant, you may be going to a lower end restaurant. You may be going to a McDonald's. So you're seeing McDonald's that is not under pressure as much as some of these other stocks. Also getting a bid today is Bitcoin and gold as well, guys.
And meanwhile, Inez, we are seeing oil prices hitting a 5-week low today. Brent crude here down about 5%. What's dragging down the sector?
Yeah, look, it's the same as the banking crisis, the uncertainty about a recession, crude futures, as you mentioned, WTI. You can see this drop off here, down 5%, Brent crude as well. Analysts had been saying at the time when OPEC Plus had announced those cuts, you remember those cuts that they announced back in April, that OPEC Plus was getting ahead of a recession where they were seeing demand would be dropping off. So that was preemptive ahead of a recession. But those gains that we saw immediately after OPEC Plus announced that production cut, those gains have been erased. BP did report its quarterly results, mixed results. Revenue grew 14%. You saw that their earnings decreased 13% year over year. Now, some interesting commentary, though, from BP regarding oil prices. It's saying that oil prices will be elevated in the second quarter as it expects those production cuts that were announced by OPEC Plus to take effect, and also China to continue reopening. So that should tighten that supply and demand spread.
All right, Ines, thanks so much. We are just about 5 minutes to go here until the closing bell. Got that covered for you when we come back.
People are actually going to need to figure out how to be good investors going forward. And in a market that has adjustments, corrections, deviations, stresses, that's an Apollo market. You don't make long-term investments if you're measured quarterly. The whole notion or soundbite of private equity as ravaging businesses was always that, just a soundbite. We are $400 billion of private credit today, which sounds large, but I assure you, Jamie Dimon, Jane Fraser, Brian Moynihan, Charlie Scharf, they don't wake up every day wondering what the mighty Apollo is doing. And I like that.
We're seeing starting to play out in Treasuries, some of the pricing. There is rising concern here. We're starting to see the investors paying more attention to it. And I hope that will act as an impetus to get this resolved in a bipartisan way. We're a bank on a mission. We're very clear about who we are. We are the preeminent banking partner for institutions with cross-border needs. Full stop. That's it. There's no arrogance about people at Citi. We want to understand, help our clients put the solutions they need in, take real pride in it.
I think this phase of any crisis is over. I don't think there's a whole bunch of others. If you look at what's happening in inflation, it's sort of saying that we're looking at some sort of recession. How hard, how long to be determined. One of the primary reasons why TD bought Cowen is our amazing research. Culturally, great alignment. A lot of work to be done understanding how to operate our business model inside a globally systemic important bank on the combined platform. Where can we go? What are the things we can do? We have a full suite of products and opportunities in front of us. Let's pick and choose the ones where we can go out and take meaningful share.
All right, there's a closing bell on Wall Street, wrapping up what has certainly been a risk-off day for the markets. We're looking at losses across the board. The Dow off just around 371 points. S&P off just over 1%, as well as the Nasdaq. Some of the fears about the regionals, the stability there, whether or not we could see another regional lender potentially fail. That was enough to spook the markets today. Again, losses across the board, Akiko.
Yeah, Shauna, let's start there because that really did drive the losses today in the session. PacWest and Western Alliance, along with other regionals, finishing the day well in the red as investors show fear that the bank crisis is not over just yet. This, of course, comes one day after JPMorgan purchased the bulk of First Republic in a deal that was designed to restore stability to the banking system after 2 months of turmoil. And as we were saying, Shauna, earlier, it did restore sort of confidence for one day. And here we are today talking specifically about these regionals, not necessarily on any particular news, but it does point to just the jitters that still exist about another regional bank potentially failing.
Yeah, certainly there are jitters out there. And like you pointed out at the top of the program, the moves in these two banks when it comes to Western Alliance and also PacWest comes on the heels of their recent earnings report, which shows that investors were confident here within these regional lenders that deposits actually did grow in the final weeks of the quarter, and also that momentum continuing in the first few weeks of April. So we'll see whether or not maybe there's some calmness maybe restored here within this sector over the next couple of trading days, because certainly today is a totally different picture, totally different scenario than what we were talking about at this time yesterday when we were hearing from Jane Fraser, when we were hearing from Jamie Dimon, just among some of the leaders there of the larger banks, saying that this part of the crisis was behind us, at least for now. All right, shares of Pfizer also closing in the red today amid a sharp drop in first quarter revenue on the back of falling sales of its COVID-19 vaccine. Now, this coming despite an earnings beat on both the top and bottom line. So certainly investors taking some issue with some of the trends that we are seeing. While, yes, they did beat what the street was looking for, revenue, Kiko, was off just about 28%. So really showing the fact that their business has certainly dropped on that year-over-year basis.
Yeah, I mean, you could argue, Shauna, that the declines they've seen, the slowdown on the back of the COVID-19 vaccines, that's not necessarily a surprise. We were already sort of anticipating sort of things to pull back a bit as we've seen sort of the pandemic start to phase out. But there's also a bigger concern here about some of their patents expiring and what that means. The company's certainly trying to double down on additional research, bringing new products to market, but those are no real guarantees, as we've learned in this space. So that seems to be a big concern as well, based on what we heard from the company today. You see the stock ending the day down about 0.4%, so bouncing back just a little. Now let's move on to another company that we talk about a lot. Tesla, following a number of price cuts this year, Tesla is now hiking prices in certain areas. The Elon Musk-led EV company raising the price of its Model 3 and Model Y in the U.S., China, Canada, and Japan. The Model 3 and Model Y series of cars now cost $250 more here in the States, but it is still lower than where it started the year on. So the price cuts, sure, they're kind of bouncing back in just a bit. I mean, there's a fear in the market, really, that potentially those initial price cuts, especially in a market like China, kind of started a price war, if you could argue that, especially because there's so much competition in the EV space. As we always say, Tesla no longer just the only game in town.
Yeah, certainly we've seen that pressure on a number of the traditional automakers being forced here to lower their prices because of the fact that Tesla had continued to cut their prices on some of their most popular models. So you're right there. This increase of $250 here in the U.S. for their Model 3 and Model Y, we're still a far cry from what those models were selling at the start of this year. So still substantially lower. But I think this is just Elon Musk responding to some of the criticism that we had gotten from investors, what we had heard from analysts here over the last week or so, ever since Tesla reported their latest earnings, and did show that their profit margins were under pressure as a direct result of these price cuts. A number of analysts lowering their price targets on the stock as a result. We also saw a couple of downgrades there. On the flip side, some are just saying that this is going to be some short-term pain for that long-term game and that this could actually really work out to Tesla's benefit. But the street taking some issue recently with the magnitude of these price cuts overall and what that could do to pressure margins here in the short term.
Yeah, obviously concerns about those price cuts, but also, you have to wonder if there is a reset of expectations among investors, especially given where the EV market is right now with Tesla facing a lot of competition. Well, short seller Hindenburg Research has activist investor Carl Icahn in its sights. The firm now shorting Icahn Enterprises, alleging it has inflated asset valuations. You can see shares there closed down nearly 20%. Joining us now is Yahoo Finance reporter Josh Schaefer. Anytime we talk about Carl Icahn, certainly a big move there today in terms of what we saw on the back of this.
Yeah, Kiko, and there's a bit of irony, right, when we're talking about Carl Icahn, who has made himself famous and made a career of basically calling out mismanagement, right? And now he has one of the more popular short sellers of the last couple of years calling out him for mismanagement. And so essentially what Hindenburg said here was that Icahn has been using money taken in from new investors to pay out dividends to old investors. Hindenburg highlights IEP's 15.8% dividend yield and says that Carl Icahn is essentially achieving that dividend yield through effectively what they called it. They said such Ponzi-like economic structures. So Hindenburg essentially saying that Icahn is running a Ponzi scheme to some extent in order to pay out this dividend. The stock dropped about 20%. We have not heard from Icahn Enterprises. I reached out to Icahn Enterprises. We have not heard from them. Should note, though, Akiko, they do have earnings expected on Friday, and there is a conference call scheduled for 10 a.m. on Friday. So I would imagine if Carl Icahn does not speak out about this in the next couple days, we probably will still hear from him on Friday and get their formal response then, because we know when these Hindenburg reports come in, they often move the stock, but then usually the company that is being accused of wrongdoing has something to say on the other end, of course.
Yeah, I mean, no question they'll be forced to respond if we see a move like we did today. Where you pointed to the Hindenburg Research note here, they do talk about Icahn being a legend of Wall Street, but that he has made a classic mistake of taking on too much leverage in the face of sustained losses, a combination that rarely ends well. So how does it end, Josh?
It's a great question, Akiko. I'm not sure we know the answer yet, right? Because it gets to, is what Hindenburg is reporting actually correct? Because they're reporting that Icahn has committed fraud. So then you'd have to see probably federal regulators get involved in order for this to play out further. That has happened in the past, we should point out, when Hindenburg has accused companies of fraud. Remember back in 2021, they accused Nikola of fraud. That's the electric vehicle maker, electric vehicle company. And that actually was proven, and there was federal charges that did come from that. Hindenburg most recently has been in the news. They accused Block of mismanagement. They accused Block of basically lying about how many users they've had. Now Block has come out and denied that. So again, it's always Hindenburg saying one thing, the company coming and saying something else, but normally you do see some federal investigations when this kind of thing does happen, and that's sort of where we get the more clear-cut answers about what's really going on here.
Yeah, you're certainly right about that. We have seen a lot of investigations coming out of that report, which is why we saw such a big move on the back of that stock today. Josh, thanks so much for that. All right, we've got Starbucks earnings out. Shauna Smith digging through the numbers here. Shauna, what do we have?
All right, Akiko, looks like a pretty strong report here from Starbucks. We're looking at slight gains, actually oscillating here just a little bit in extended trading. A beat on both the top and bottom lines here for Starbucks, 74 cents a share. The expectation was for 65 cents. Taking a look at revenue, $8.7 billion. That beat the street's expectations of $8.4 billion. Also, overall comp sales, that coming in better than expected, 11% jump here. The estimate was for growth of about 7%. In terms of what's driving it, Starbucks saying that it was driven by 6% increase in comp transactions, also a 4% increase in the average ticket. We talked about the fact that Starbucks is one of those names that has had pricing power. They have been able to raise prices. Consumers have been up until this point willing to spend, willing to pay those higher prices. Certainly that seems to be the case in this latest report here. Also just breaking down that overall comp sales number just a bit. In terms of the U.S. comp sales, growth of 12%, that coming in better than what the street was looking for, of a gain of just about 9%. And international comp sales, that growth of just about 7%. So beat here on both the top and bottom line. Overall comp sales up just about 11%. So it certainly looks like a strong quarter here for Starbucks.
Yeah, you point to those international numbers that we got too. Certainly China, a big part of the business there. And we are seeing some reversal, at least in the same sort of declines over in China. That's got to be helping the cause too, although we are seeing the stock down about 0.7%, so reversing just a bit, but not a significant move on the back of it. In China, it is interesting, as you point out, anytime we look at some of these food and beverage companies, the Starbucks certainly a big one. It is kind of an indicator of where the consumer mentality is right now, especially in the face of inflation and how sticky that's going to be. Are they willing to shell out extra money even with the price hikes, at least based on the numbers that we got right now? It certainly feels like that's still the case, at least for Starbucks.
Yeah, it certainly has been the case. It seems like it is the case right now. I think a lot of the focus is going to be on exactly that on the earnings call, what the trends they are seeing so far this quarter, because we know that there has been that rising risk of recession in the second half of the year. The macro picture has not really improved substantially. If anything, we're seeing more and more consumers pull back on some of their discretionary purchases. So whether or not they're seeing any signs that that is going to be something that analysts will want to hear a little bit more about on this call. But when you take a look at Starbucks' performance since the start of the year, the shares up just about 15%. So maybe a lot of this good news already baked into the stock price. Maybe that's why we're not seeing more of a reaction here in extended trading. I also want to note that the new CEO there at Starbucks saying that he's very pleased with the reinvention progress so far of the company. And also Starbucks reporting U.S. rewards membership up 15% here to 30.8 million members. We know that loyalty program, rewards program has been so critical in order to drive and keep that momentum going in Starbucks sales. All right, let's get over to another earnings report here after hours. Ford is out with its results. Brad Smith has got that for us. What are you seeing?
We're taking a look at Ford shares actually moving in reverse here, lower in after hours as the company is reporting earnings that actually beat on both the top and bottom line. EPS was expected to come in at about 40 cents based on the Bloomberg consensus estimates, came in at 63 cents, and then revenue came in at $41.5 billion. That was versus the $36.28 billion there. So really interesting to see the activity here, still continuing to dive in on some of the numbers, but the company is reaffirming its cash flow, its free cash flow targets for this year of about $6 billion here. We do have in a statement from the Ford CEO, Jim Farley, saying bringing Ford Plus to life, zeroing in on what distinct customers need and value the most. Of course, remember, this is a company that is electrifying some of its most popular units, that being, of course, the Ford F-150 Lightning. You're also taking a look at some of the others that they are now reopening orders for in the Mustang Mach-E as well. You got that news earlier today, as well as some pricing strategy that the company is moving forward with as they've reopened orders for Mustang Mach-E. Better EPA estimated ranges they were touting there with that announcement, and some lower pricing as well. So that's going to be particularly of note. And on that announcement, they had to say that they upgraded some of the Blue Cruise that's going to be rolling out for new and existing Mustang Mach-E owners. But getting back to some of the earnings numbers here and really trying to dive in on what particularly is moving shares lower here after hours, you got to wonder on one of the metrics that customers are continuing to look across in this broader kind of price war that has ensued within the EV landscape, if this is impacting margins. Of course, coming into this report, the gross margins were expected to come in at about 16.4% for Ford. And so I'm just continuing to look through, and ultimately we did see net income come in at about $1.8 billion. That's compared to a net loss in the 2022 period, and primarily kind of driven by a change in the company's investment in Rivian mark-to-market there, they're mentioning. But adjusted earnings before interest and taxes, or EBIT, that came in at about $3.4 billion. It's actually an increase of 45% and a margin of 8.1%. So just continuing to look through some of the line items here, but that is the top and bottom, as well as some of the context and color or the paint job around Ford right now.
All right, great job there, Brad. Again, the stock under just a bit of pressure here in after hours. Let's get back to Starbucks, because the company beating on both the top and bottom line. When you take a look at the reaction in the stock, off just about 1%, $8.7 billion in revenue, adjusted EPS of just about 74 cents. Also, overall comp sales coming in better than expected, growth of 11%. Here with a deeper dive on these numbers, we have Sean Dunlop. He's a Morningstar equity analyst. Sean, it's great to see you here. So just first, your reaction, because to me, the numbers look strong, yet the street doesn't seem to be too excited about it.
It's true, yeah. Certainly a beat on the top and the bottom line. Comparable store sales strength looked great. Continuing to see positive traffic in the United States is impressive and suggests that the firm has not exhausted its pricing power yet. So I would say that the street reaction is potentially reflective of expectations for demand normalizing in the back half of the year. That's certainly something that we're cautious about, although it was interesting to see the firm reaffirm its free cash flow guidance for the full year. So I guess we'll see on the call.
Sean, I wonder if we can broaden this out just a bit because, we were just talking about where the trade downs are happening with consumers as they have to deal with higher prices that are still out there. Certainly doesn't feel like that's necessarily happening at Starbucks, but when you look at the broader sector overall, where are you seeing some of those changes?
Yeah, we saw traffic at McDonald's is up 5% during its most recent quarter. And so we're clearly seeing consumers trade down into the QSR category from somewhere. A lot of the time that might come from upscale fast casual, that might come from full service dining. But by and large, restaurant spending has held up really well year to date, even though we've seen consumer savings rates flag. So as we move into the back half of the year, it will be interesting to see. That core Starbucks consumer doesn't usually trade down the menu so much as they trade out of the category. Maybe you go a couple fewer times per week or per month. And that is where we'd really expect to see pressure show up potentially.
Sean, when you take a look at the average ticket here, an increase of just about 4%, Starbucks has clearly had pricing power up until this point. Do they still, and could we potentially see higher prices here over the next quarter or two?
Yeah, I think it's unlikely that we'll see higher incremental pricing. I'd say most operators in our coverage have been very cognizant of a pressured consumer and very careful to try to do what we'd call a barbell pricing strategy, where you've got some consumers that will trade into premium products, and maybe that's where you take prices, whereas some of the more day-to-day product, for example, for Starbucks, like a hot coffee, they'd be very reluctant to take price increases there. Now with 4% increases in check, part of that's going to be just normalizing channel mix as people return to downtown occasions where they're just ordering for themselves rather than for a full family in the suburbs, for example. But given that is reflective of both price and mix, there's a little bit of noise in the data, so it'd be good to see that unpacked in the call.
Yeah, aside from the U.S., we have seen a bit of a reversal for Starbucks, especially in their other large market, China, given the pickup that they've seen. How much do you anticipate that momentum to pick up? It feels like there's a bit of a mixed bag when you talk to people about how the reopening is happening over in China, although certainly it feels like things are starting to slowly pick up.
Yeah, we're just getting to normal in the Chinese market, and it's important for Starbucks, but it's more important as you look forward. So it's good to see them continue to invest heavily in opening new stores in that region. We expect a pretty sharp snapback in the region over the back half of the fiscal year. I believe we have something to the effect of 60% comp sales growth in the third quarter as you lap some pretty draconian mobility restrictions. Now, just to give investors a sense of the magnitude of that market, it's about 10% of Starbucks' consolidated revenues, but it is important because it represents about half of the international net new units over the next decade. So we'll definitely be keeping an eye on the market. The rebound has been anything but linear, but certainly see a better prospects for the second half of the year.
Sean will likely hear from Loxman on this earnings call. It would be his first if he is in fact on that call. What do you want to hear from him, and what do you make of his presence and what he has done with the company? It's only been a couple weeks, but what you have seen so far.
Yeah, it will be very interesting. I would expect that it would be non-news this quarter, sort of walking the party line and the strategic priorities as they've been laid out in the firm's reinvention plan. Anything other than that, I think, would be newsworthy if he seems to take a different tack towards labor relations or perhaps emphasizing or de-emphasizing other company-owned markets like the UK or like Japan. That would be something that would certainly catch the eye.
Sean Dunlop joining us there with Starbucks' latest results. Thanks so much for that. Well, coming up, be sure to stick around for After the Call. Shauna's and Brad Smith will tell you what you need to know from the Starbucks earnings call. It all starts at 6 p.m. Eastern time right here on Yahoo Finance. A lot of people going to be listening in, especially with the new CEO, hopefully on that call. Well, coming up, more from the Milken Conference is Brian Sazi sits down with Saks CEO. That's coming up on the other side of the break. Well, the consumer is proving resilient in the face of higher prices and the threat of a recession. Earnings reports so far pointing to consumers continuing to spend on everything from snacks to candy. Travel demand is also up, and we're seeing even more strength in the luxury consumer. LVMH shares hitting a record high earlier this month after first quarter sales doubled. Yes, doubled analyst expectations. For more on retail and the luxury consumer, let's head out to the Milken Conference in LA, where we've got Brian Sazzi, joined by Saks CEO Mark Metrick. Brian?
All right, thanks so much, Mark. Thanks for joining Yahoo Finance. And really, over the past few weeks, we've gotten some really good reads on the state of the luxury shopper. Louis Vuitton, very good. Other players, good as well. What are you seeing online in your stores, because you run that online operation at Saks?
Yeah, first, I think the luxury consumer is kind of painted with a bit of a broad brush. So there's it's a whole continuum. And we're seeing different things from different folks as they sit on the continuum. You have those that are sort of dipping their toe in the pool every once in a while. They buy one thing as a reward or a treat. And then you move all the way across the continuum to those who sort of luxury courses through their life. It's how they travel, it's how they shop, it's what they wear, it's how they spend their free time. And we're seeing a different sort of behavior across that, while that core, tried and true luxury consumer is certainly holding up the best.
How do you explain that? Is it the stock market still doing pretty well? Why are they spending so much?
I really think, luxury is more than just stuff. It's not transactional. I think to that core luxury consumer, again, it's part of life. And as you see this pivot that people are making, put the macro aside for a minute, and just as people flip back into services from goods, as we emerge from the last couple of years, they're traveling, they're going back to work, they're going out to dinner. Those all require wearing new things, and especially in the luxury world, that's where we're winning.
That consumer can't show up wearing the same thing twice, I guess, right?
No way.
Talk to us about, I'm reminded actually by this conference and all the people here, we are back out traveling. People are back in the office. What does the wear to work uniform look like?
I don't think there's a uniform. I think that's the good thing about fashion. I think what's happened is, especially with men over the last couple of years, even pre-pandemic, you saw people trying to become much more individual, no more uniform. So you're certainly seeing people getting more tailored and more dressed up again than even last year, which is good. But you're the first tie I've seen in a hell of a long time.
Take this off, snip. Well, are you not selling men's ties? Is that out? Is that look? What I'm wearing, is it completely out of date?
You
can tell me, it's fine.
No, I think, to be honest with you, that's the difference now with fashion, especially with men. It's whatever you want. It's however you want to express your fashion and your style, which women have had for a long time, but us guys, it's new for us. So if that's how you feel great and that's how you feel comfortable, we have it, it's available. I just see less of it.
Well played, sir. So in terms of women's fashion, what's going on in there? What are they buying? What are they not buying? And more importantly, what are some of the top brands that are selling?
Yeah, I think, it's really what are they buying? It's this move again. You're seeing a lot more getting dressed again. So you're seeing women wearing blazers again and getting dressed again. And I'm not saying that in the way of sweatpants during the pandemic. I'm talking even just, it's certainly much cleaner of how people are getting together. You're seeing fewer sneakers. I'm not saying they're all the way back into like a high heel, but it's certainly a more comfortable shoe. So you're seeing that espadrille or the flats. So women are certainly inching their way into a different place than where they were. As far as brands, look, it's a full spectrum. And it's about, again, what's important. What we're seeing less of are brand logos on the product. I think it's a lot more quiet, so to speak, from what people are wearing right now.
Who's the core Saks shopper? Is there an age demographic that is essentially driving your business right now?
Look, I think, again, it's that whole continuum. And at Saks, we're very focused on the lifetime value of a consumer. So just like most on the luxury side, we'll index fairly high with a concentrated number of customers. But our focus really is on catching customers as they enter their luxury continuum and try to ride them up as they go.
A couple of years ago, you split from your stores. Now, I remember covering that. And there was a wow moment in retail, because nobody that I know of was splitting up the store business from the online business. You run that online business. What has life been like after doing that?
Look, I think it's been great. And, I have to tell you, it's a sense of pride to kind of answer a lot of the skepticism with, one, how the businesses are performing. We don't report it or think about it together, but I'll share with you as an ecosystem, which is what we call the combination of my online business with our partners at the SFA stores. That's up over 40% versus 2019. Okay.
Your overall sales this year?
In 22, just fiscal 22, for that period of time up against 2019. And 2019 was a high watermark for the business. We were up, on a 3 or 4 year run going in. So it's working from that respect, but it's more about the consumer and what kind of deep connections we can form with that consumer. And if you look at it, actually we have 40% increase in our consumers that shop both channels from 2019. And that's not some kind of fake burst from the pandemic, because even this year we're up 5% versus last year. And that's customer shopping both channels, which in luxury was a little bit slower to take off. So I feel like it's a win-win and it's working as planned.
Is it Saks specific? Why don't I see anybody else doing this in retail?
Look, I think everyone's got to do something first, and we were there. And we have a very, very loyal customer base. We have a fantastic name with great recognition, with 90% brand recognition. It was easy and very effective for us to launch as a pure play into the marketing world. So it makes it easier. And the partnership with SFA stores allows us to really execute on that omni-channel promise. We have 40 stores. It's not like we have 900. We have high average order values. So the unit economics that we're doing business with, are much more effective to do something like this with, whereas it's just not going to be as easy for everybody.
So if you're not out there signing off on new stores, in terms of the website and the operations itself, what are you focused on this year?
We're focused on the customer experience. And when I say that, it's not just about shipping. It's not just about, it's about, how deep we know them. It's about personalization. It's about mining the data that we've quite frankly have always had, but haven't done it as effectively as we can do it now. I think the future for us, obviously powered by technology, the advancements we've been able to make, the investments we've been able to make, all of that is going to inform, much better decision making, both on our marketing tactics and how well we know our consumer and what kind of deep connections we can have with them.
Does AI play a role in your business at all right now?
Of course. Right now, the focus, a lot of it is on efficiency in the back of house and what we're using it for. But we use, forms of machine learning and intelligence on our site, whether it's recommendation engines that we have. 95% of our email communication is personalized, and that's done through AI. So there's work being done. It's early days, but certainly I feel very good about the progress we're making.
Before I let you go, real quick, is your company public?
No.
Within a year or two? Do you have any ambition to go public?
Right now, the ambition is to make this the best customer experience we can.
All right, well, good luck to you in that journey. Saks CEO, Mark Metrick, good to see you. Enjoy the rest of the conference.
Thanks so much.
Appreciate it. Guys, back to you.
All right, Brian Sozzi there joining us from the Milken Conference along with the Saks CEO, Mark Metrick. Appreciate that interview. Moving on here, Ford shares trading lower in after hours after reporting its first quarter earnings. Joining us now is Autoblog editor-in-chief, Greg Migliori. Greg, it's interesting for all the talk of EVs and this company in transition. It really was the legacy business that helped drive the gains here. We're talking about what is known now as Ford Blue, earning $2.6 billion.
Yeah, I give Ford credit for breaking out the different parts of their business. This is really a creative approach, if you will. We haven't really seen this in the automotive space before. So again, like I said, it's a creative approach to trying to explain where their priorities are. The results are basically what we expected. The traditional parts look pretty strong. The electric side of the business, as expected, you're seeing some, challenges there, if you will. Another side is the Ford Pro business, which is like commercial work trucks. That's actually a pretty lucrative business, which I think industry insiders already kind of knew, but now the whole world is getting to see that. So it's a very interesting earnings day for Ford.
Greg, what do you think is keeping investor sentiment in check right now? Is it the losses from its EV division? And how much do you think that also has to do with the increasing competition within the EV space that we've seen from a number of those traditional automakers?
Yeah, I think right now what we're seeing is there's so many different players getting into the EV space that investors are trying to figure out which horse to bet on. Is it sort of the new flashy thing like a Rivian or a Lucid? Or do you look at more of a traditional legacy automaker like, General Motors, Ford, Volkswagen, Mercedes, who all have, very deep portfolios or they're growing them in the electric space? It's interesting. Ford has a lot of great electric vehicles. I've driven the Lightning, that's the F-150, the Mach-E, that's the Mustang crossover. These are very solid vehicles. So I think, the big challenge for Ford and for Jim Farley is to communicate the quality of these vehicles to the marketplace and to, of course, the stock market.
Greg, how long until we really start to see the full impact of the IRA? Obviously, when it was first passed, there were questions about incentives and to what extent, individual cars and brands would get the full incentive. Now we know the impact, at least for the Ford EV. When are we going to start to see that reflected in a big way?
Well, I think it's part of that becomes out of the consumers. How quickly do they decide to adopt it? How quickly do they pivot to these types of vehicles? So I think we're at least a couple of years away before we really see the full effect of that. And a big part of that also is even out of the hands of the automakers. It's, how is the infrastructure? Is it going to get there? Are people going to be able to charge their electric vehicles easily? Are they going to be able to charge them quickly? So, there are some things that are a little bit out of the hands of the automakers at this point.
Greg, what about the pricing war? I think we can call it that. That's broken out clearly among a lot of these automakers here. We had the news that Ford would be changing the price of its Mach-E because of some of the pricing moves that have been done at Tesla. What does that mean just in terms of the pressure that we're going to see in the margins of this business and how much Ford can really go with slashing their prices, given the fact that their margins are totally different when you compare it to what we're seeing at Tesla?
Yeah, I mean, right now you could get a much better deal on a Mach-E than you could have, a few days ago. Let's put it that way. These are significant price cuts, anywhere from $1,000 to almost $4,000 right on the hood. So they're significant price cuts. And the Mach-E, as an aside, actually gets a little bit better for the new model year. They're using a different battery chemistry, which will essentially make the batteries better. It's similar to what Tesla uses. So I think what you're seeing is, you said it right. It's a war. The F-150 Lightning, I think they probably underpriced that a little bit. And now they're seeing such strong demands that they've raised the prices on that one. And then with the Mach-E, you're in a little bit of a very competitive space and they drop it down. And that's interesting. You also saw Tesla today put an extra, I think it was very small, like $250 onto the pricing of the Model 3 and the Model Y, which are, of course, some of their slower selling vehicles. But I mean, pricing with the regular car market is kind of crazy right now. And then when you look at the electric space, it's writ large. It's kind of wacky. Let's put it that way.
Certainly is. And it's tough to keep up with all the changes that we're seeing at what seems like a daily basis. All right, Greg Migliore, always great to have you. Thanks so much for joining us again. Ford shares off just about 0.3%. Well, coming up, another round in the battle between Disney and Florida Governor Ron DeSantis. We are joined by the former executive vice president of operations for the Walt Disney World Resort. On the other side of the break, stick around. The drawn-out fight of Disney versus DeSantis. The board overseeing Disney's special taxing district, appointed by Florida Governor Ron DeSantis, is suing the House of Mouse just a week after Disney filed a lawsuit against DeSantis to stop punishing the company for Disney's protected speech. So how exactly did we get here? Yahoo Finance's Alexandra Canal is here to break it all down. Allie.
Hey, Shauna, and this Disney-DeSantis battle, it's shaping up like a classic Disney tale with a hero, a villain, depending on which side you look at it. But it all stems back to last year when Florida introduced the Parental Rights and Education Act, otherwise known as the Don't Say Gay bill. Then CEO Bob Chapek initially decided not to speak publicly on the matter, but faced intense backlash from the company and its employees. He eventually reversed course, which angered DeSantis and triggered the fallout seen today. Less than 1 month later, though, DeSantis signs that bill into law, creating a deeper divide between Disney and the state. Chapek, of course, he's still in that CEO position, still dealing with disappointment from employees. And little does he know that this will be one of many factors leading to his ousting in November. 1 month later, DeSantis signs that bill, stripping Disney of its self-governing status, known as a special tax district, Reedy Creek. At the time, there were many questions about how this would play out, who would handle these tax payments. Flash forward to 2023, and we finally have some of those answers. Now, this is where the drama really heats up. We have a new CEO in Bob Iger and a whole new set of problems. On February 10th, the Florida Senate approves a bill to dissolve Reedy Creek, setting up DeSantis to be in control of that board. Now, later that month, on February 27th, DeSantis signs that bill into law, gaining control over the district and appointing that controversial 5-member board. Reedy Creek, it is no longer. It is now known as the Central Florida Tourism Oversight District. Then, after undisclosed last-minute meetings on the side of Disney, 11th hour proposals to basically circumvent the authority of that board, DeSantis fired back, threatening taxes, a state prison, possibly another theme park. He also proposed legislation to have Disney go through more inspections of its parks, prompting Disney to sue. That bombshell lawsuit coming last week, with Disney alleging the governor launched a, quote, targeted campaign of government retaliation, threatening its free speech. And then on Monday, less than 1 week later, we had the board countersuing Disney to void, quote, backroom deals favorable to the media giant. Now, what happens next? That largely remains to be seen, but unlike those Disney stories that you and I know and love, this likely won't have a happy ending, Shauna.
Certainly not, and the feud doesn't seem to be stopping anytime soon. Allie Canal, great stuff, breaking all of that down. We want you to stick around because here to discuss more on the Disney versus DeSantis, we want to bring in Lee Cockerell. He is a former executive vice president of operations for the Walt Disney World Resort. Lee, it's great to see you again. So neither side, like Ali said, backing down. DeSantis really finding out that taking on Disney is maybe much tougher than he initially anticipated. How do you see this all playing out for Disney?
Well, I think we're going to sit in court for a long time, but I'm still trying to figure out why he's doing it. There's never been a clear explanation other than Disney executives not agreeing with some legislation he was recommending. Somebody told me a long time ago, if you can't explain it, you don't understand it. And we still don't understand what the upside of this is for him. Why would he do this? He was a congressman for 5 years. He was the governor for 4 years before now, and this was never an issue. He never brought it up, never talked about it. None of the other governors of Florida have ever talked about it. And it looks just like he became angry over somebody pushing back on what he wanted to do. And certainly Chapek's responsibility is to look after the company and the employees of the company and to speak up like any company does when different states are trying to pass legislation or even the federal government. It's common for companies to speak up and give their opinion and to push back. And that's kind of the American way. So I'm not quite sure why he decided to take this on. There seems to be no upside for the state. Actually, a lot of expense with the legal costs he's going to have to deal with this. So I don't know. I just think it's going to take a long time to play out. And unless we can get a better idea of what he thinks is the upside for the state. You know, he keeps saying that we're pushing back or Disney sticking their thumb in the eye of the voters. I've never heard, I ran Disney World for 10 years. I was with Disney 16 years. I've never heard anybody complain about this situation, about this arrangement. So I don't know what this means, sticking the thumb in the eyes of the voters of Florida.
Lee, I just want to ask you, you teach management and leadership classes. You just mentioned how long you were at Disney. Now we have Bob Iger back in that CEO position. How would you rate how he has handled this entire situation? Do you think suing DeSantis at this point, that was the right move from a management perspective?
Well, I think at the time it was, our employees and cast members at Disney World were up in arms over this, and many of our guests. And we had no issue. I don't even think anybody understood the level.
Lee, are you still there? All right, looks like
trans. I don't think they were. They were not doing that in the first place. So, not quite sure how this got to that situation.
So Lee, moving forward, how do you think this impacts Disney from a short-term perspective and also over the longer term, especially how much awareness this is getting, how much national attention this is getting right now?
Well, everything I'm seeing, it's helping Disney. So I don't think, there have been many disagreements over the years. The public didn't like this or that, depending on what it was at the time. And we've had little boycotts and complaints, but I think you're not going to see any impact on the attendance of the parks. I don't think it's an issue. I don't think 99% of the people out in the world are even thinking about it or care about it.
Lee, what do you think, though, that this could potentially do for future investments? There's been lots of talk about backlash here that Disney is going to take its investments and leave Florida and seek another state. Do you think that something like that is potentially on the table?
No, I do not. This is like a city. It's a mammoth place. No, Disney's going to be here, and they're going to be here for a long, long time, probably forever.
And given how this has played out, what sort of precedent do you think this sets for other consumer-facing brands and companies when it comes to taking a stand and voicing political opinions and exercising their free speech?
Well, I think it wasn't so much a political opinion as it was there was some legal legislation being passed that Disney did not agree with. And I'm sure there's going to be much legislation, whether it's Democrats or Republicans, that certain organizations do not agree with, and it's not good for their business. And I think this is not new to push back against the legislature. And I think it's normally the way the world works and the way America works is you give your opinion, and everybody has an opinion, and they're not restricted from giving it. And so this just seems to be, I hate to use the word retaliatory, but I can't figure out any other reason why he's doing this. We haven't heard a good, solid reason why this is a good idea for the state of Florida to be pushing. And by the way, there are over 1,800 special districts in Florida. This is just, we happen to be one of them. And they're done all the time in every state in the union.
And Lee, I know you're a teacher, so I'm going to put you on the spot real quick. From start to finish, how would you grade Disney and its management and its handling of this?
Well, I don't think there was any way to go. I think they were in the middle, and that's one of those things you can't do the right thing one way or the other. We had employees on one side, and we had the government on the other side, and Disney did the best they could, and this happens. I don't think Chapek could have handled it any differently. So there we are.
So what do you think, an A?
What's
sounds
that?
Sounds like maybe a B.
An A, a B? Somewhere in between?
Yeah, it's going to play out, and it's like companies all over the country have problems with legislation. And they push back, and whether it's oil drilling or you name it, every subject in the world, there's somebody for it and against it, and companies have to protect their rights too. This is a public company. We have shareholders, and I don't think the state of Florida needs to be running it. And by the way, all the things, this opening a prison and putting tolls on the roads, that wouldn't have, I mean, that's absurd. And actually, I think those examples just show you how strange this whole thing is.
Certainly is strange, and it doesn't sound like, and it doesn't sound like this feud will be ending anytime soon. The back and forth here. Lee Cockrell, great to have you, former Executive Vice President of Operations for the Walt Disney World Resort. Akiko?
Well, shares of regional banks plunging today on fears the banking crisis is not over. This comes after banking giant JPMorgan Chase rescued First Republic after its failure on Sunday. JPMorgan CEO Jamie Dimon telling analysts Monday, quote, this part of the crisis is over. Clearly, though, investors still concerned when you look at the reaction in the market. Citi CEO Jane Fraser joined Yahoo Finance from the Milken Conference in Los Angeles and spoke about the strength of the banking system.
I think this was the last remaining main uncertainty of the small handful of banks that did not do a good job with asset liability management, and also, were the victim of the steepest rate curve increase we've seen in 40 years. But nonetheless, it is a small handful. And as we look at the overall U.S. banking system, this is a strong, this is a safe, this is the envy of the world.
We're here with more reaction from the Milken Conference. Is Yahoo Finance's mighty team on the ground? We've got Brian Sazi, Ali Garfinkel, and Rick Newman there. Guys, I was out there yesterday. It feels like there's a bit of a split picture, would you say, in terms of how people are feeling about where the financial system is right now? On the one hand, Brian, you had that conversation with Jane Fraser, who said, look, the fact that banks could step in was a good sign, and yet you've got other executives who are saying the implications for the U.S. economy are just beginning.
It was so great to see you, Akiko. Yes, this has been a very crowded conference, guys. 4,000 people, 280 panels, and it just felt like 4,000 people and 280 panels. But really a takeaway for me is, despite all the banking concerns, Citi CEO Jane Fraser telling us she views the banking system as stable. Nobody really knows where the economy is going. You have a camp saying we are in a recession. You have a camp saying there might be a recession later this year. And you have a camp saying things are optimistic and fit into this theme, Rick, of a thriving universe, which to me it's hard to stand up and believe in when we're just, 24, 48 hours after one bank got gobbled up by a very giant bank in JPMorgan.
Right, and Citi CEO Jane Fraser told the whole conference yesterday with the last piece of uncertainty is out of the way, and guess what? No one believes her. I mean, the market, at least fair to say the market doesn't believe her, otherwise we wouldn't have more regional banks plunging today. So the conversation today has now shifted to, okay, how do we get out of this? And I heard a really interesting idea from former Secretary Steven Mnuchin at a panel just a couple of hours ago. He favors raising the FDIC deposit insurance limit to $25 million. Wow. Right now it's $250,000. He says raise it to $25 million. That's not a crazy idea. This is actually an idea that's out there. The idea is, instead of having this cutoff point where some deposits at banks are insured, and then above that they're uninsured. It's those uninsured deposits that are the problem right now. Those are the deposits coming out. So Mnuchin, there are others who say just have unlimited FDIC insurance. You're not protecting shareholders, you're only protecting depositors. But I thought it was quite interesting to have Mnuchin sign on to that idea. Charlie Scharf, the CEO of Wells Fargo, was on that same panel. He was kind of like...
They've had a lot of troubles, of course.
Yes. Charlie Scharf was like, 25 million, I don't know about that. Because somebody has to pay for that extra insurance. So, Masters of the Universe out here, and they're trying to figure out how to solve this problem just like everybody else.
The thing is, really, they might raise it to 25 million, but it doesn't solve how management teams are going to run these banks.
Exactly.
Because the argument could be made, Ali, that a lot of the risks we are seeing now, a lot of these bank failures have been because of bad management teams, misguided compensation packages, and a whole lot of people doing a whole lot of things wrong.
Because you know what this feels like to me, Brian? This feels like First Republic and JPM was Monday. Now it's Tuesday, and we have to press forward.
Wait, it's Tuesday?
It is Tuesday, right? A bunch of economists I've been talking to are staring down the barrel of this Fed meeting, and they're split too. What they're saying, I was talking to one yesterday, the Flexport chief economist, who was saying, nope, there's going to be many more rate hikes. I was talking to another who was saying, nope, this has to be the last one, or the economy will absolutely rebel. Though the thing is, I will say, the only place I'm hearing optimism is AI. I was expecting to hear a lot more skepticism, but in fact, what I'm hearing is just opportunity. Opportunities in fintech.
I'm going to come back on that because
hold on, we're going to come back to that. I mean, to be fair,
I'm going to keep doing the name dropping here. And
all right, let's do it. Let's do it.
CW CEO, Katie Koch, new CEO.
I did her makeup.
6 weeks into the job, used to cover tech a lot at Goldman Sachs. She said it's going to be a job destroyer, AI, and I think that fits really well to the story we woke up this morning with Chegg, the stock getting absolutely slaughtered because of what is happening and what may happen down the line because of AI.
And what I'm hearing from absolutely everyone else is job creator, and that Chegg is an anomaly. The actual interesting thing, the most interesting thing I heard, I'd argue, is that from Greycroft co-founder Dana Settle, more name dropping, who said to me that actually there is one area that AI won't touch, and that is the consumer. Consumer goods, ChatGPT can do a lot of things for you, but it's not going to make your skincare.
Rick, final word to you. Biggest takeaway from this conference?
Let's go back to banking. There's a second wave coming in banking, and it's going to be what happens when the credit crunch. So the people here at the Milken Conference are the people who issue the credit, who take out the debt at every level of the capital structure, right? And we know this is going to hit commercial real estate, but I've been hearing specifics about what part of commercial real estate. It's mostly business properties in large cities, and it's second tier business properties in large cities. And the implications or the outright predictions are that we're going to see bankruptcies. There are going to be a lot of companies, maybe middle companies, that are going to get stuck in that funding squeeze. And that is what this credit crunch is going to be later this year.
Tremendous insights and tremendous work from both of you. I thank you for both for being here and doing all that work. Guys, back to you, New York.
All right, great work out there. Thanks so much for that, our team out there at the Milken Conference in LA. Let's go over to Shauna here for a check on some after-hour movers, some big earnings out there moving things as well, Shauna.
Hey there, Kiko. We're going to take a look at four names: Starbucks, Ford, AMD, and Match. Let's get right to it. Starting off with Starbucks. The stock actually under pressure here in extended trading, off about 2%, despite solid results. The company beating up both the top and bottom line. Also, overall comp sales coming in better than expected. We saw growth of just about 11%. Year to date, we've already seen the stock tick up just about 15%, so maybe potentially some of that beat already baked into the stock price. Of course, a lot of focus is going to be on the earnings call this evening and what they're seeing in terms of consumer trends and how much people are continuing to spend. So again, the stock off just about 2.5%. Taking a look at Ford, that stock also in the red in extended trading. That company beat here on sales of $41 billion. The company also saying that they expect their electric division to lose about $3 billion this year, consistent with what we had heard from Ford in the past. Now, despite this beat, Ford did maintain its outlook for the year when it comes to its 2023 guidance of adjusted earnings. They expect between $9 billion and $11 billion. So we're seeing some pressure here in extended trading. Investor sentiment clearly a little bit worried about the guidance and also maybe some of the consumer spending, what that could mean down the road if the macro picture does in fact continue to worsen. Taking a look at AMD, that stock off just about 4.5%. The forecast did not impress the street. We're seeing that reaction in the stock price here after hours. Now, the company did say it is confident in the growth that they expect to see in the second half of the year, and they do expect to see adjusted gross margin expansion in the second half of the year. For its most recent quarter, the company coming in better than expected, adjusted EPS of 60 cents, revenue of $5.4 billion, but the forecast is really what's driving the action after hours. Again, the stock up about 38% as we look to the chip sector to figure out whether or not this slight recovery that we've seen since the start of the year, whether or not that momentum can continue. And rounding it out with Match Group, that stock now up just about 3% here in extended trading. Its GQ revenue forecast actually falling short of what the street was looking for. It sees its full year sales at the lower end of its 5 to 10% range. The company, though, did announce a new $1 billion buyback program. They also said that they do plan to launch a new dating app this summer, and they do plan to continue to further roll out and test weekly subscription packages. So maybe the street a little bit excited about that. But again, the stock up just about 3% in extended trading. Year to date, off about 16%. All right, well, it is closing time here at Yahoo Finance. Let's get you caught up to speed on some of the biggest headlines of the day. First up, stocks ending the day lower across the board. All three of the major averages ending the day down by more than 1%. Now, this comes as concerns about regional banks linger. Oil also ending the day 5% lower over worries about the economy slowing. You see that reflected in the price of crude.
Yeah, down more than 5% there. We are starting to see the ripple effects of ChatGPT's growth as well. Chegg shares sinking 48% after the CEO of the online learning platform told analysts and investors they believe ChatGPT is starting to have an impact on their new customer growth rate.
All right, and looking ahead to tomorrow, all eyes will be on the Fed's interest rate decision. It's widely expected the Fed will raise rates by 25 basis points as part of the ongoing battle against inflation. We will bring you that announcement as soon as it's released right here on Yahoo Finance Live. Before we go, the biggest story of the day. This is Akiko's first day back from maternity leave. And look at her little daughter there, Mayari, the most adorable thing. Akiko, how's it feel?
Yeah, I have to say that, so number one, you think 4 months off. I mean, I'm just grateful to have a company that has supported me through that. But I have found a new appreciation for parents. I don't know how you do it with 2 kids, Shauna, because it has been sleepless nights, real sleep deprivation for the last 4 months, more so than doing the morning shift here, by the way.
I know. It does get a little bit better. You just got to take it day by day or else you're going to start drowning yourself. Not to scare you. It's the best thing in the world. Just a little, tougher. All right, guys. Well, that'll do it for us today on Yahoo Finance Live. Be sure to come back tomorrow, 2 p.m. Eastern Time. We'll have that Fed decision for you. Bring that to you live. Have a great night.